Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxVox. My guest today is American Enterprise Institute senior fellow, Kyle Pomerleau. Before joining AEI, Kyle was chief economist and vice president of economic analysis at the Tax Foundation. He has his master's in public policy from Georgetown University. We'll be talking about the Inflation Reduction Act, the massive climate, health, and tax bill passed by the Senate on Sunday and expected to get final approval in the House tomorrow. Before we begin, our usual bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event's being recorded and will be posted online at TPC's website. We're using captioning, which you can adjust or turn off with the live transcript button at the bottom of your Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Kyle Pomerleau, welcome to The Prescription.
Hey, thanks for having me.
Great to see you. So let's start with the title of the bill, the Inflation Reduction Act of 2022. So will this bill, in fact, reduce inflation?
I think that the bill is going to have minimal impact on inflation one way or the other. So I agree with others like CBO, Penn Wharton budget model that these effects are probably indistinguishable from zero. Standard way of thinking about this is fiscal policy can impact the demand for goods and services by increasing spending or cutting taxes or vice versa. This bill, at least in the first couple of years, has a very small impact on the budget deficit. I've seen estimates that suggest this may increase or slightly decrease the deficit over the first 4 years, but then in the long run, it's going to reduce the deficit. So close to zero just from fiscal policy in the short term, but ultimately the Federal Reserve is in charge of the price level. So even if this were to increase the budget deficit and put upward pressure on prices, I think the Fed would react and we'd ultimately not see much of a change in the price level due to this policy. So yeah, minimal impact.
I guess the one place where this bill may have some effect on consumer prices are the drug negotiation pieces, but those don't take effect for some years.
Yeah, that's right. So, and I think that there's also, at least in the way I think about this, distinguishing between, I think what some have called microeconomic and macroeconomic effects of these policies on prices. You could have say a tax change, like on an excise tax that increases the price of a good because the after-tax price has gone up. And call that like a microeconomic effect. That's a little different than looking at the macro effect of the price level overall, that it's more money chasing goods and services. And when I'm thinking about this, I'm looking at that latter effect, the macro effect. While it is true that some prices are going to end up lower due to this bill.
So while the sponsors claim, of course, it will reduce inflation, there are some critics who say it'll do just the opposite. They say higher taxes will result in higher prices for consumers. So is there any truth to that claim?
When I think of tax policy and its impact on prices, I think it's very minimal. So I think one place where we've seen this argument is with respect to the corporate minimum tax or corporate taxation in general. That because corporations are going to have to pay this higher tax, they're going to pass that forward as higher prices. I think in an open economy where prices are set in a world market, that's much less likely. I think what you see when you raise a tax on production like that is it's what some say is passed back to the factors of production. So what instead is going to happen is returns to investors are going to go down, and then some of this also is going to mean lower after-tax wages to the extent that this impacts investment. Now, in real terms, this means we're poorer. So in real terms, in a sense, prices have gone up because our purchasing power is a little bit lower. But nominal prices, again, I think that's mostly in the purview of the Federal Reserve and isn't going to be impacted by small changes to corporate tax policy.
If we have time, we may get back to this corporate incidence debate, because I know we could spend a whole half hour on that. But let's talk about some other things first. So let's get into the details of the bill. The biggest provision is this book minimum tax on very large corporations. It's projected now to raise about 220 billion over the next decade. Could you give us just a really quick description of how it would work?
Under this proposal, large corporations, those reporting $1 billion or more in net income on average over 3 years, would be subject to this tax. And under the proposal, they would have to pay the greater of 15% of their adjusted book income or their financial statement income or their ordinary tax liability. Their tax burden under the book tax is adjusted. They are able to take accelerated depreciation deductions in calculating the tax. They are also able to use general business credits to offset the tax. And then any taxes paid in excess of ordinary corporate tax generates a book tax credit that then can be carried forward to offset ordinary corporate tax liability in the future. And this carry forward of a credit is important because what it's doing is it's in effect, it means that the book tax is kind of a prepayment of ordinary corporate tax. It's more of a timing thing rather than a top-up tax. And we might get to this too. That's one of the fundamental differences between this tax and the global tax deal and how that's structured.
Yeah, I think we should probably clarify that for the audience, because unfortunately there are two corporate minimum taxes in debate right now.
Yes.
So maybe tell us a little bit more about how this one differs from the OECD's minimum tax.
Yeah, that is a confusing aspect of this bill and the debate overall, is that there are currently two 15% minimum taxes that use book income that were being considered. So the book minimum tax, the one that passed as part of the Inflation Reduction Act, that is more of a corporate AMT. It's domestic focused, and its focus or goal is mainly addressing the perceived unfairness of large multinational corporations paying an effective tax rate below 15% relative to their financial statement income. The other 15% minimum tax related to the global tax deal, the goal of that proposal is to reduce the incentive to shift profits and high return activity like intellectual property into low tax jurisdictions. So the goal there is for countries to come together to set this minimum tax rate to prevent what has been called the race to the bottom, where countries reduce their tax rates in order to attract highly mobile income and investment.
So some people, not many, but some people have argued that the book tax that Congress is about to pass would be compliant with what the OECD is trying to do. What do you think?
I disagree with that. I do view these as two separate taxes with two separate effects. And there are lots of differences between these two taxes, but I'll just point out one that I think is important. So proponents of the global tax deal point to our current minimum tax on foreign profits, GILTI, global intangible low tax income. They say it has a fundamental flaw, and that flaw is that it is calculated on a worldwide basis, that countries add up all their foreign profits, all their foreign taxes, and then whether there's a top-up tax or not depends on what that average effective tax rate is. So if it's below this 13.125%, there's a top-up tax, but if it's above, there's no top-up tax. And the argument is that because companies can average together low tax and high tax income, it still leaves space for companies to shift profits out of the United States or out of other high tax jurisdictions into low tax jurisdictions. So Pillar 2, the global tax deal, the reforms that would move GILTI in that direction would go to a country by country calculation, meaning that companies would no longer be able to do this averaging to reduce their tax liability and continue to shift profits into low tax jurisdictions. Well, the book minimum tax looks much more like current law GILTI than it does Pillar 2. If you think of the book minimum tax, what it's looking at is the overall effective tax rate of a company's worldwide operations, not just foreign, but also domestic. So in terms of averaging, there's a lot there for companies to do. In fact, if a company has a high effective domestic tax rate, it could still potentially profit shift because they may not be subject to the minimum tax, even if they're sending money to a jurisdiction with an effective tax rate of 0% and paying no GILTI on it for due to averaging there. So just that one difference is that I think is important enough to say that these two are not the same thing, and the book minimum tax I think shouldn't be considered part of the global tax deal.
So if the U.S. is not going to go any further than this book minimum tax towards what the OECD is doing, what do you think that means for the future of the global minimum tax? Some people argue that the U.S. now is not going to deal with this for some years. Will other countries just go ahead and do it and leave us to catch up? Or how do you think this is going to play out?
Yeah, there's the question of what the United States does, and then the question of what other countries do. So I think for now, the debate over the global minimum tax is paused. I don't think it's going to be moving forward anytime soon. There are potential tax cliffs coming up that could push lawmakers to want to revisit reforms, but those aren't until, say, 2025. So there's a ways to go. Then there's the question of what other countries are going to do. Now, there's an argument that Pillar 2, the way it's designed, it encourages other countries to join in, even if say the United States doesn't, because the way it works is, if the U.S. isn't going to be taxing low tax profits, other countries are going to pick up that revenue. So it's still possible that other countries move forward, but on the other hand, there may be concerns about competitiveness if, say, one of the largest economies on Earth doesn't go with this, but other small open economies do. Those small open economies may be more sensitive to competitiveness concerns. So you could see either sides of that argument. But then that kind of interacts too. So if other countries go ahead and go for the global minimum tax, this could put pressure on US lawmakers to want to do it. So it's not just the cliff in 2025 that pushes in that direction, but if other countries go ahead and they're taxing activity in the United States or profits in the United States, lawmakers may say, well, revenue is being collected. Why doesn't it just go to the US Treasury instead of overseas?
Better we get the money than somebody else. So let's go back to the domestic version, the version that Congress is about to pass. You and I have both written about the flaws of the book tax. Could you just walk us through a couple of them? What's wrong with this?
So I've pointed out three concerns that are high on my list here. So certainly this raises revenue for the federal government, and that goes towards funding the important priorities in the Inflation Reduction Act. But as a revenue raiser, I think there are some concerns with it. So first, I think that because under this, you'll be subjecting book income to tax, there is a worry that the informational quality of book income may decline. But we know under current law that companies reduce their taxable income in order to reduce their overall tax liability. Well, if book income is subject to tax, there may also be an incentive there to reduce revenue, increase expenses in order to reduce book tax liability. Concern number two is there's this partial outsourcing of the tax code to a nonprofit entity, FASB, Financial Accounting Standards Board, located in New England. This board, they determine the rules under book accounting, and changes that they make to book accounting in the future could now impact fiscal policy in the United States. It would impact revenue collections. So that outsourcing is a concern, but then the concern goes the other way, that if FASB is able to have some control over revenue collections, this puts more pressure on Congress to, say, maybe take a trip up to Connecticut or call members down to Washington, D.C. and ask, what are you doing here? Why are you doing this? And put pressure one way or the other on financial accounting rules. And certain changes may or may not be made for revenue reasons rather than for financial accounting purposes. Then the last concern, which I have to update this analysis a little bit, is its an impact on investment incentives. So originally, the concern was that because a big book tax difference that exists under current law is accelerated depreciation. Under the tax code, companies can deduct capital assets like machines, factories faster than they usually do for book tax purposes, that the book minimum tax for a company perpetually subject to such a regime would face a higher cost of capital, and it could reduce the incentive to invest and have a negative impact on the economy. Now, since its passage, accelerated depreciation has been carved out. So companies that use accelerated depreciation significantly, they are not going to be at risk for going into the minimum tax, being subject to the minimum tax. So this direct effect of thinking about the book minimum tax as raising the cost of capital isn't really there. Mm-hmm. But I still think that the book minimum tax can distort investment decisions, even without accelerated depreciation being considered or being clawed back. And the nuance here is thinking about this as a parallel tax at a different tax rate that companies are sometimes subject to and sometimes not subject to. So when you think of the effective tax rate or the amount a company is paying in tax on investment, you think about the value of deductions and the taxes they pay on returns. And under a tax system where the rate is consistent and deductions are consistent, that's very straightforward. But imagine a system where you're bouncing between taxes, where the value of deductions may be higher and lower in some years, and the tax burden on returns are higher and lower in some years. So this tax could still raise the cost of capital or even cut taxes on new investment for some companies, depending on how they interact with the tax. And taking this a little further, there are also book tax differences that kind of go in the opposite direction. This hasn't been discussed much either, that for example, for tax purposes, research and development costs are amortized, while for book purposes, they're primarily expensed, and interest expense, it's limited under the tax code, but fully deductible under the book tax. That kind of points in the opposite direction, that lawmakers are inadvertently cutting taxes on certain types of investments that by implementing this book minimum tax.
So it's interesting to me, as you pointed out, that this version has a number of exemptions, including a large share of the general business credits, all of the green energy credits, accelerated cost recovery, which accounts for the largest difference between book and taxable income. It's interesting that when they made the change, it knocked a third of the revenue out of the bill. Almost $100 billion was knocked out. So the book tax, to me, is starting to feel a lot like the income tax base. One wonders why they're even doing this.
Yeah, I think this all comes back to the political perception of companies paying low effective tax rates. I argued all the way back in 2021 that even before they went for the exemptions for a lot of these things, that this tax was not going to eliminate the phenomenon of companies paying zero tax, because that's just the way the tax code works. Companies have cyclical income and expenses over time, and the tax code has to deal with the fact that companies can have negative income in certain years. And the minimum tax has always had net operating losses deductions for its calculation. So there was always a chance that companies were going to be paying low effective tax rates under this provision. And this second piece, where there's these additional exemptions, that makes this point even stronger. But I think it goes back to a tension that's always been there back when Biden originally put this forth, is that, on one hand, you want to encourage companies to do certain things that you deem are good, invest in green energy, for example. But on the other hand, you are worried about the fact that they're paying low effective tax rates. And those things are in tension, especially when your subsidies are baked into the tax code.
So, you and I can sit back at our think tanks and we can criticize the book tax and talk about the flaws that you just described and I've written about and other people have written about. We could also say that if Congress wants to get rid of corporate tax preferences, it ought to just vote to get rid of corporate tax preferences, but clearly it's not doing that. So in the real world, given the politics of the bill and the need to raise revenue, was this the best they could do?
Yeah, so that I think is the stronger of the arguments that are out there, that without this provision, there wouldn't be an Inflation Reduction Act. Therefore, this provision is fine. I think a lot of arguments in favor of the book minimum tax boil down to that, because yeah, we could talk all day about flaws in this tax and why changing the tax code it would be better from a policy perspective. I'm certainly no fan of the book minimum tax, but yeah, I've seen a lot of the arguments, they boil down to that point, that politics really limited this. That's an unfortunate side effect of our system here. And you think about this, that if that type of decision is made over and over and over again for each subsequent bill that changes tax code, that's how you end up with the tax code that we currently have. I mean, we could point to certain provisions in the Tax Cuts and Jobs Act that no one's really a fan of that ended up in there, but it ultimately boils down to the same argument that, well, there wouldn't have been a Tax Cuts and Jobs Act without X, Y, and Z provision.
Section 199A call home, right?
Yes, I wasn't going to name it, but yes, that is one that comes to mind.
So let's talk about the other big provision, really the only other significant provision really in the tax increase side, which is a 1% tax on stock buybacks. A good idea or a bad idea?
Yeah, so so this was a provision that was introduced late in the process. It's been, the proposal has been hanging about for a while. It was originally proposed by Senator Ron Wyden as a 2% tax on stock buybacks. The way this works is the corporation earns its profits, it pays its corporate tax, and then if it decides to distribute those profits as buybacks, it is subject to this 1% tax. There are a few exceptions to it in order not to hit certain types of saving in the economy. Now, this, I think, is another tax where you could say it is a second or third best. I think the arguments in favor of this, and I think there are many at TPC that have argued or argue in favor of this and have written about this, is that under current law, there is a slight tax benefit for stock buybacks that I think you could trace back to the tax benefit that capital gains in general have under a system of realization. If I am a company and I know that I have shareholders that are sensitive to tax, I might want to do a stock buyback instead of dividends, because under a dividend distribution, those profits are immediately taxed at the shareholder level, whereas a buyback lets taxpayers choose whether they are going to receive this payment and pay tax immediately, or defer liability and pay tax later. So that's a benefit. There's also a benefit for foreign shareholders that others have pointed out, where dividends face a withholding tax where capital gains don't. So this, I think, is one of those second or third best solutions to an issue where there's a tax differential between the treatment of different types of capital income.
So as you implied, companies can sort of do three things, right? They can either buy back stock, they can pay dividends, or they can use it to buy capital or
retain their earnings. Yeah.
That's right.
Yeah.
Do you think that this 1% tax is going to have a material effect on the choices that businesses make?
Somewhat. The tax is small, and companies, I think, are trying to minimize tax liability on their investments across both their entity level and for taxes on savers. This 1% tax, I think, is going to shift behavior somewhat away from buybacks towards dividends, because that relative tax burden is changed. Certainly 1% tax, again, not a very big tax. You can see from the Joint Committee on Taxation estimates that this ends up raising revenue to some degree. Some of that may be because of behavioral effects, but some of it is just the excise tax is going to end up collecting revenue. And on net, just on a macro sense, this is just at the margin going to slightly increase the cost of capital for companies. Companies are going to, when they make investment decisions, they consider the return they need to provide their shareholders after tax. And to the extent that this tax impacts that, it's going to make investment decisions or investments a little bit more expensive at the margin, but I don't think the effect's going to be very large. I think Tax Foundation just released a new analysis of this, and they think its effect on GDP that's less than 0.05% in the long run. So not a big effect.
It's interesting. The S&P companies broke a record in the first quarter of this year in terms of stock buybacks. And the paradox here is that because the effective date of this provision is December 31st, we may actually see more buybacks. We may see a rush to share repurchases to avoid the tax.
So that's an interesting point and something worth highlighting here. That's a change from Build Back Better to the Inflation Reduction Act. The Build Back Better Act, when it had the 1% stock buyback tax, the effective date was retroactive to January or December 31st, 2021. This one's December 31st, 2022. So the Build Back Better provision was better structured in a sense to avoid this type of behavioral response where companies accelerate stock buybacks in order to avoid the tax. But I think that that's a behavioral effect we may see under this version of the stock buyback tax.
So speaking of second or third best choices, there are also all the energy credits in the bill. Yes. Dozens and dozens of them. What effect do you think these are going to have on demand for fossil fuel?
So I think that, this is a second or third best solution. I have written a few times about the merits of a carbon tax, a direct price on carbon emissions in the U.S. economy. Green energy subsidies, I think they, theoretically, you could construct a policy where subsidies and tax are very similar and do very similar things, but they are suboptimal. So to some extent, green energy subsidies will move people from dirtier sources of energy to cleaner sources of energy. But one downside of a green energy subsidy is think that consumers, their demand is not inelastic. When the prices of energy changes, consumers are going to increase or decrease their consumption. And part of the money being spent on these green energy subsidies may actually come in, be seen as an increase in the demand for energy overall. So there may be some substitution, but because you're not directly pricing carbon emissions, what you're probably also going to be doing is just increasing the demand overall for energy through an increase in demand for green energy. And another downside too is that to the extent there is shifting, the shifting isn't going to be perfectly efficient from the perspective of reducing emissions, because there are all sorts of technologies that spew carbon into the atmosphere, some more than others, say coal versus natural gas. And the green energy subsidies, they're going to be increasing the demand for green energy, but they're not going to really be telling consumers, well, you should shift away from coal more than natural gas because coal is worse. So the swap may not be as optimal as just directly pricing carbon emissions.
We could probably talk for a half an hour about the efficacy of a $7,500 tax credit for purchasing electric vehicles that you actually can't buy because the demand already outpaces the supply.
Yeah,
that's another story. We have just a minute left, and let me ask you a broader question. Let's end with this. We're living in an environment where Republicans are unwilling to raise taxes on anybody, and Democrats are unwilling to raise taxes on households making less than $400,000, which is 95% of the population. Given our rising deficits and debt, is it sustainable to exempt middle-income people from future tax increases?
Yeah, so I think that if government spending is going to continue to be at its current level or rise because of demographic factors, that I do not think it is sustainable that any discussions of tax policy exempt large proportions of taxpayers. So I've discussed this in other places, that I think that reforms to the tax code, but also additional sources of revenue, need to be in the form of broad-based taxes. I think that lawmakers should, politically difficult it is today, sometime in the future, they may need to discuss things like a value-added tax or a carbon tax that can raise a significant amount of revenue at a low rate and with minimal economic damage.
Well, Kyle Pomerleau, thank you so much for joining us. It's been a great conversation, and
Thank you.
hope to have you back again soon. And thank you to our audience for joining us.